All right. Subcommittee will come to order. There are minutes from the last meeting that are in front of all of us. I'll give you guys a chance to read them. I have no comments. Are there any comments or questions on the minutes?
This is what we got in the mail.
The minutes of the front.
Yes, I remember that,
Yep.
yeah. No, Mr. Chairman, it's fine with them. I move for adoption of the minutes.
Second.
All in favor? Aye.
Aye.
Motion carries. Now we're going to, Ernesto, if it's okay, we're going to turn it over to Janet for an introduction. Following the opening comments, we're then going to go into executive session and then come back into public session.
If I may, Mr. Chairman, before I move on to Janet, just to let the committee know what we're doing, we are first continuing our discussion from our first meeting and wrapping up some decisions based on where we left off. You gave me an opportunity to continue to review the materials from the last time and send you some ideas on where we would end up. And then the consultants will go into investment policy review part 2, which is on the structure of the investments and the manager selection process. Prior to that, Janet Crone, our Chief Investment Officer, will do a quick recap and review of what they're going to provide us, and then they're going to go into their presentation. And at that point, we will move into executive session. At the conclusion of their presentation, we will move back into public session and have a discussion on how we move forward with the Committee on Fiscal Affairs.
Okay. So we're going to be in public session for quite some time.
We'll be in public session for the next 5 minutes, move into private session, and then come back later on to discuss our second steps with the Committee on Fiscal Affairs.
Okay.
Okay, Janet, why don't you take it away?
Okay. So just to set the stage, I want to recap what occurred at our last meeting, also address the concerns that were expressed at that time, and also to, in our thinking since then, to present a proposal for an alternative asset allocation. So if you turn to the back up to the memo that you were sent, to the first page after the memo, where it's entitled Recommendations, we'll take a look at, just in broad strokes, the Cambridge recommendations, which are to first redefine our return objective to a 5% real rate of return objective from our current nominal 9%, which would be a meaningful target, and it would eliminate the need to predict inflation. Second, to establish a formal spending rule of up to 5% based upon a 12-quarter trailing market value. And this would serve to give us fiscal discipline and at the same time facilitate the preservation of the pool's capital. Third, and we'll get into this a bit more, an asset allocation, which would give us the option to get into several new asset classes, including emerging markets, alternative investments to include marketable and non-marketable, and real assets. All of these things would increase the diversification of the pool, reduce the risk, and enhance the probability of achieving higher rates of return and protect the portfolio in times of inflation and deflation. Finally, the investment policy we're proposing is to enhance the governance structure to permit the subcommittee the authority to act upon decisions of substance, and for the staff to have the responsibility for implementation in order to facilitate a more timely decision-making process. That summarizes the Cambridge recommendations. There were some concerns expressed the last time with regard to hedge funds in particular, and in particular with hedge funds, the issues related to spending policy and liquidity. So if you turn to the next page on the spending recommendation, we've looked at spending for endowed and non-endowed funds by college, and what we found is that for, on average, historically, both endowed and non-endowed funds have not exceeded a 5% spending rate. There is a range, there are some exceptions, but as you'll see in the process for implementation that we come up with, we would address that with some flexibility for the exceptional situations. Also, I'd like to point out that the total withdrawals that you see on the next page would indicate that we could go up to a 10% allocation in non-marketables before we would run into any problems with liquidity. And the other factor that we like to keep in mind is that with non-marketable programs, the capital calls are drawn out over a 5-year period. They're not drawn out all at once. So we don't have to be concerned about a lot of money going out at once. And as I said, we propose an implementation process, which is 2 pages further into the presentation, which would not only provide communication of the spending policy to all colleges and participants, but it would incorporate an ongoing monitoring process on the withdrawals, and it would incorporate some flexibility to permit, in special situations, flexibility to go beyond the 5%. We don't anticipate that this would occur a lot, and at that point we would probably extend the time period of historical spending for consideration, because there are just times when the colleges will be maybe exceeding this. So that really summarizes the Cambridge recommendations, covers the 2 issues with regard to spending and liquidity, with regard to hedge funds, and then moving forward to the proposal for an alternative asset allocation. If you turn to the page that says asset allocation recommendation, where it shows policy target alternative 1 and 2, I'd just like to preface this by saying that Ernesto and Barry and myself have given this a lot of thought, and we are very mindful of the concerns expressed at the last meeting. And we looked at the alternatives below, and we are very comfortable with alternative number 1, which would reduce the marketable alternative exposure to 5% and take that difference of 10% and split it equally between the non-marketable and real assets, as we feel these are asset classes that promise the better returns going forward. And we would propose alternative 1 for the reasons that it would really further diversify our fund, increase the expected returns, and substantially reduce the volatility. It would provide insurance in times of inflation and deflation. It would allow for a very minimal exposure to hedge funds, and we want to emphasize that we will not address this area until markets stabilize. But we would like to address the option of having it in the policy now, so we don't have to come back to the table at that time. Further, this combined with the spending policy would go a long way towards the preservation of capital, and it would create a portfolio which we hope would be very attractive to the other colleges and enhance the prospects for co-investment. And with that, I'd like to turn it over to Cambridge for discussion on further discussion.
Okay, we can now go into the executive session.
All in favor? Yes, we are.
So if you turn just to the next page, which is the one where we have the modeling, looks like this.
Next page in Janice.
In Janice, just
Yes, we
Yes.
are.
just to show you that we did some modeling on these alternatives, and they actually came out more or less at the same risk-return profile.
Briefly discussing the objective return with the 5% real objectives, 5% spending rate as being appropriate, asset allocation policy target alternative 1, combined with the governance issues that we discussed, as well as the investment policy statement that would need to be created. That's what I believe our recommendations are. I'd like to put it forward. Is there a second?
Second.
Discussion?
No discussion, Mr. Chairman.
Okay. All in favor, say aye.
Aye.
Any opposed? None? Motion carries. So this will move forward to the full fiscal affairs committee, and I'll entertain a motion to adjourn.
So moved?
Second.
All in favor? Aye.
Aye.
Thank you all.
Perfect, thank you.
Good work. Thank you very much,
Thanks.
sir. Really good work.
All right.
Thank you. Have fun tonight.
It was very clear, thank you.
Excellent. Well, again, I mean, to the extent that we have any individual